Stop scrolling. The biggest lie Wall Street ever told just cost investors over $6 trillion. Think about that. $6 trillion disappeared. In less than 2 years, 99% of AI startups are projected to be dead. How did a technology that promised to cure all diseases and replace 95% of human work become one of the most spectacular financial disasters in history? This is not hype. This is a story about math so bad it looks impossible, fueled by tech CEOs who convinced investors to spend $40 for every $1 consumers actually spent. My name is Aaron. I've been tracking financial bubbles since Bitcoin was boring. Today, we're breaking down the AI bubble, how it formed after ChatGPT launched in late 2022, why the actual products are failing 95% of the time, and the single day a Chinese competitor triggered the largest single-day corporate loss in American history. You need to understand this, because if this bubble bursts, it could take the entire American economy down with it. By the end of this video, you will know the 4 deadly secrets OpenAI doesn't want you to see, and why your job is probably safer than they want you to believe. The company that pays you to use it. Rewind to 2024. OpenAI, the company leading the revolution, was valued at $500 billion. That's more than Walmart or JP Morgan Chase. But here's the secret they kept quiet. In 2024, OpenAI generated $3.7 billion in revenue. But they lost $5 billion. That means for every dollar they earned, they spent $2.25. They've never made a profit. The more successful they are, the faster they bleed cash. This isn't just an OpenAI problem. Competitors like Anthropic saw their valuation jump from $18 billion to $183 billion in less than 2 years. And one founder raised $2 billion without a product, a demo, or even a business plan. Just a name. Investors were literally throwing money like Monopoly cash because they were terrified of missing out. Have you ever bought something that costs you money every time you use it? Of course not. That's insane. But that is the actual business model driving the entire AI hype cycle. Take GitHub Copilot. It's one of the most popular AI tools. Developers love it. It costs customers $19 a month. Seems reasonable, right? But Microsoft, which runs it, pays $30 per month just to operate it for that customer. That's an $11 loss per user every single month. The better the product does, the deeper the hole gets. It's like running a restaurant where every meal costs you more to cook than the customer pays. How long can that possibly last? You might think, well, maybe they'll fix the costs later. But even the biggest believers know the math is broken. Goldman Sachs, one of the biggest names on Wall Street, ran internal tests using generative AI tools in their own offices. They're finding? Using the revolutionary AI tools costs 6 times more than just having humans do the work the old-fashioned way. 6 times more expensive. Wall Street got this devastating internal report, and what did they do? They ignored it completely. Why? Because the money train, led by one company, was moving too fast. If you're finding this analysis shocking, and if you realize you need to protect your money from this kind of insanity, please do me a favor and hit that like button. It tells the algorithm that real finance, not just hype, is what matters, because the insanity of losing $2.25 for every dollar earned is only half the story. The other half involves power grids, massive chips, and a terrifying spending gap. The 40-to-1 gap that broke reality. The AI revolution isn't built on software, it's built on hardware. Specifically, specialized chips called GPUs, sold almost entirely by one company, Nvidia. Nvidia became the ultimate proof point for the bubble, skyrocketing to $4 trillion in market value by mid-2025. They were selling the shovels in the digital gold rush, and everyone needed those shovels. Big tech firms like Amazon, Meta, Google and Microsoft spent $344 billion on AI infrastructure in 2024 alone. That's more than 1% of the entire US GDP. The industry, as a whole, was burning through $400 billion to $500 billion annually just on infrastructure, data centers, chips, power. Now, hold on to your hats. How much were American consumers spending on actual, useful AI services per year? $12 billion. Do you realize what that is? That is a 40-to-1 spending gap. For every single dollar consumers spent, the industry was spending $40 building infrastructure that operates at a loss. There is no credible path to closing that gap. None whatsoever. The absurdity of the spending led to something even worse: circular financing. You need to see this diagram. It looks exactly like the shady dealings that fueled the 2008 financial crisis. It starts with Nvidia, who invests billions into companies like OpenAI. OpenAI then takes that money and immediately buys billions in GPUs from Nvidia. Nvidia also owns part of CoreWeave, a cloud provider. Guess who CoreWeave's biggest customers are? OpenAI and other AI startups. Nvidia is paying for companies to buy its own chips, which inflates Nvidia's revenue and props up the demand for the entire market. It is revenue round-tripping. It's creating demand that looks real, but is really just money sloshing between the same 5 pockets. This isn't innovation. It's a financial echo chamber. And this infrastructure binge is causing real-world problems. Data centers already use 1.5% of the world's electricity. The US grid, built in the 60s and 70s, cannot handle this. We are literally running out of power capacity. The AI boom is slamming into a literal wall because there's nowhere left to plug it all in. Your job is safe. The 260 Chicken McNuggets test. While the finance world was busy propping up stocks, the actual products that were supposed to justify this $600 billion frenzy were failing spectacularly. A new MIT study found that 95% of generative AI projects fail to deliver returns. They look great in demos, but when you put them into real workflows, they fall apart like cheap furniture. We saw high-profile flops instantly. Remember the $700 Humane AI pin? The device that was supposed to replace your smartphone? It was universally panned, called the worst product of the year. The company shut down 10 months after launch. It processed more returns than new sales. But the truly embarrassing failure came from McDonald's. They spent millions over 3 years on an AI drive-through system with IBM. What happened? Videos went viral, showing total disasters. The AI was adding 260 Chicken McNuggets to orders, or giving customers $147 bills for a simple combo. McDonald's quietly shut down the entire system, sending millions down the drain and going back to human workers. So, you still worried about AI replacing your job? How can a technology that fails 95% of the time and can't handle a simple fast food order manage your complex work? Even the creators admit it's fundamentally broken. OpenAI publicly stated that hallucinations are mathematically inevitable. Their most advanced models hallucinate 30 to 50% of the time. This isn't a bug you patch. It's a fundamental limitation of the technology. And despite the promises of AI-fueled prosperity, what followed? Mass firings. 130,000 tech workers lost their jobs in the first 7 months of 2025. IBM even fired 8,000 employees after replacing HR with a chatbot. But months later, they rehired many as contractors because, surprise, the chatbot couldn't actually do the job. The fear that AI is coming for everyone's job. That was partly fueled by the tech CEOs themselves. It drives investment. It's a genius fundraising strategy. Invest in our powerful, dangerous hats before they kill everyone. The day Nvidia lost $500 billion. For 2 years, The bubble was inflated by audacity and hype. But every bubble needs a trigger to pop. That trigger arrived on January 27th, 2025, from an unexpected place: China. A Chinese competitor called DeepSeek launched an AI model comparable to GPT-4. The catch? It was trained for a fraction of the astronomical cost American companies swore was necessary. The narrative instantly collapsed. The belief that Nvidia's high-priced chips were essential for survival evaporated. The headline read, "Nvidia loses $589 billion in a single day," the single largest one-day corporate loss in American history. It wasn't an isolated event. It was the start of a cascade. In the following months, over $6 trillion in market value vanished. Even Sam Altman, the high priest of the AI cult, had to admit the truth. Yes, we're in a bubble. He compared it directly to the dot-com crash. The warnings are official. The Bank of England issued a formal warning that valuations are stretched and the financial system is vulnerable. And Deutsche Bank warned that the massive AI spending is currently holding up the entire US economy. When this bubble bursts, it will take everything down with it. The technology is real, but the financial model built around it is fake. Just like the dot-com bust wiped out thousands of startups, but gave us Google and Amazon, this pop will kill 99% of today's AI companies. But the survivors, the boring ones building chips and data centers, will build the foundation for a sustainable future. The question is, are you bullish or bearish on AI right now? Are we watching the biggest financial bubble of our generation inflate right before our eyes? Or will AI somehow prove the skeptics wrong? Let me know your thoughts in the comments below. And if this video helped you understand the chaos behind the hype, hit the subscribe button and turn on notifications. You don't want to miss our next deep dive into where this $6 trillion went.